Hello, everyone. Hope you're having a good lunch hour. My name is Cindy Yuan, and I'm a 1L representative for the Harvard Association for Law and Business. I'm your moderator for today's event.
Hi, everyone. My name is Forrest Lin, and I'm also a 1L representative for HALB. I'll be moderating the audience Q&A portion of this latter half of the talk.
We'd like to first thank everyone for joining us today at the 2021 HALB Symposium event. At our symposium this year, we welcome leaders in business and law to talk about the challenges brought by 2020, namely the COVID-19 pandemic and the racial inequalities that continue to plague our communities. In addition to reflections about their work in the past year, we discuss how leaders in different industries can respond to these challenges in charting the path forward. I am still honored to be here today with Mr. Jeremiah Gordon from CapitalG and to hear about his efforts on diversity and inclusion in growth investing. Jeremiah is the General Counsel and Chief Compliance Officer of CapitalG, Alphabet's independent growth fund, which has $3 billion under management and has invested in well-known names including Lyft, Airbnb, and Robinhood. Jeremiah manages legal and regulatory affairs for CapitalG and is involved in all aspects of the fund, including fund formation, deal execution, portfolio management, and international investments. Before CapitalG, Jeremiah was a senior counsel at Google, where he worked with Google's corporate development team on acquisitions, investments, and special projects. Jeremiah is currently co-leading Google's effort to invest $100 million in Black-led startups, investment funds, and organizations. Jeremiah is also named one of National Diversity Council's most influential African Americans in business for 2021. Now, just to quickly highlight the structure of our event today, we will begin with a moderated Q&A with Jeremiah, and we do hope to leave the last 15 minutes for audience questions. So feel free to submit questions throughout the event via the Zoom chat function. Jeremiah, thank you again for joining us. I know I gave a very quick summary of your career, but I barely did it justice. You have made several transitions in your career from Big Law to Google and now to CapitalG. So could you tell us a bit more about your career path and how that has led you to the role at CapitalG?
So I could start off by, first of all, thank everyone for having me. I think it's a really important and good thing you guys are doing, sort of bringing folks from the community who are practicing and in leadership roles back to talk to folks that are in school. I was an idiot when I was in law school and just studied and hung out and didn't do this type of thing, but I think it could be, if done correctly, really helpful for you all when you graduate. So thank you for the invitation. In terms of career, I could start off by saying, look, I had some great master plan that worked out, but that would be completely untrue. I think my career sort of progression and development has been a series of sort of serendipitous moments combined with excelling in roles that I've been given the opportunity to have. And also a series of sort of long-term and deep relationships throughout various sort of legal communities and business communities. So let me start there. So when I was in your position, I think you're a 1L, but when I was a 2L, I went to Cravath for the summer. My rationale for going there versus other firms doesn't really, it was all kind of silly season at that point. I didn't have any great. My family's not lawyers. I didn't know anything about this. So I went to Cravath because I liked the building and I like whatever. And I went there and it was a really good experience. I did a bunch of stuff for 2.5 years. Then I went to the West Coast to do, because I'm from California, to work, because I was also interested in technology, to go work at a big technology law firm. I did that for 4 or 5 years. And the middle of the last sort of Great Recession, I was asked if I would go down to Google on a secondment for 3 months. And then after 3 months, I would go back to my law firm. And then presumably in a couple of years, I would make partner in my law firm. That was kind of what was being told to me. So I go down to Google for 3 months. I think the 3 months becomes 6 months. The 6 months becomes 9 months. And then one of the senior executives at Google asked me if I would stay full time. And so it was actually a hard decision for me because I had always thought of myself as staying at a law firm for my career. But I said, you know what, it's Google, I'll do it for a year or two. Then I got there and I really liked it because the law firm job is very different than the in-house job. The law firm job is about being a real expert in a very specific domain. And the in-house job is being sort of able to communicate what's going on with the legal stuff, but also problem solve and be a business driver. And so I did that for 3 or 4 years. It was going good. I was starting to get a little antsy And then the folks who were running corporate development at Google got a mandate to start a growth stage investment firm. And I had done a little bit of VC and investment work in my prior law firm because everyone that does tech work in California has done a little bit of it. And so I said, look, they sort of asked me if I would be general counsel. I said, yeah, that's fine, I'll do that. And when I started, it was a very small operation. There were like 6 of us. Fast forward 7 years or 6 years, and we've now invested over $3 billion. We have been involved in some of the more interesting corporate and economic sort of companies and stories that have happened in technology in the last 5 or 6 years. And we've grown into both an actual real firm as well as a real economic story. And so I've been very happy and enjoyed being on this journey, but it wasn't something that I started in 2003 when I graduated from law school with a plan of how do I get to go be general counsel of some growth equity fund, because I honestly didn't even know what growth equity was when I graduated from law school.
Yeah, that is really exciting to hear. And thank you for being so open and honest and sharing your career path. I'm sure a lot of us will find inspiration from your journey. Now, as the general counsel of CapitalG, you're involved in all legal aspects of the fund. So could you talk about your major responsibilities along with the common legal and compliance issues that you deal with on a daily basis?
I guess I would start with, it depends on the day of the week. I have a very broad ambit as to what I do at CapitalG. And so I think it would be more instructive if I just tell you what we do. So our business is making growth stage investments in high growth technology companies. And so for us, this tends to be investments that are sort of $50 to $100 million first check in companies who are valued between $500 million and $2.5, $3 billion. And the hope, if it works out well, is those companies tend to do multiple rounds of financing. We can eventually put more and more capital in, and you hope that at the end of the rainbow, you get either a really positive M&A event or a really positive IPO. So that's the core of our business. And the core of my job is supporting our investment professionals as they invest in, maintain ownership in these companies, and exit. Now, obviously, like for a lawyer, where you really can dig in and add a lot of value is on the front end on the investment to make sure that one, we're diligencing things appropriately, and two, that the documentation reflects the business deal we think we're getting. And then also at the exit stage, where there's real money on the table and the terms and the conditions and how it all works really matters from a returns perspective. So that's sort of core job. The rest of there's another piece of my job that I sort of call the rest of the job. And it is basically everything else. So we are a real investment firm and a real fund. And what that means is that our professionals are paid like everyone else that's in the investment business. And so we have a what I call a deal with our limited partner, which is Google, that is sort of documented and maintained. And so we have to do carried interest and grants and how do you split the profits up and who controls. We sort of go through all of that on a periodic basis. And so I'm heavily involved with that. And the key point in there that is a massive, I spend a lot of time on because it's really important, is the employee HR piece of it. How much are you getting? Do you understand the terms of your deal? Oh, you're leaving. Oh, you're coming in. How do we have a conversation about how things work at CapitalG? So that's sort of one part of it. The next part of it, I would say, is sort of what I call regulatory. So we are an affiliate of Alphabet, obviously, and that means that we are under a high level of regulatory scrutiny. And so every time we make an investment that is required to be notified under the FTC, or we make an investment in a regulated industry, or one of our portfolio companies has an issue like sort of Airbnb and Lyft, we have to find support and resources both for us as an investor, as well as if the company needs assistance, I will help the company as well. And then finally, I would say is we have gone through periods of time at CapitalG where we've been more or less leaned in on international investments. And so I have been to China like a bunch of times for this fund. I've been to India for this fund. And those are much more complicated and much harder because it's a different legal jurisdiction. There are different rules, and the way that you set up, manage, and maintain those investments just takes more work. And so I have a role in overseeing all of that work as well.
Got it. These are all really interesting and exciting issues to hear. And it's really helpful to know how there are so many different issues that can come up in just like what you might think is the ordinary operation of the fund. Now, despite the pandemic, we're still seeing US-based venture-backed companies setting historical records in total fundraising and the number of mega rounds. So what are your thoughts on the strength of the VC and growth equity market today? Are there any verticals or any trends that you're particularly excited about?
I laugh because you kind of asked the question in an inverted way. So there will always be money to fund US technology businesses as long as this technology stock market is trading at the multiples it is right now. Like you will always have new money in the system and you can get it out of these multiples. Like that's just a fact of life. And the reason I focus on the end game is that the market right now is frankly oversaturated for capital. Our fund had the busiest Q1, and now we're starting Q1 today, Q2, excuse me. We had the busiest Q1 that we've had in 7 years of existence. And all of my friends that are GCs at other sort of growth equity and VC funds will tell you the same. The reason for that is that the capital markets have been, as I said, have been very elevated. And because of that, capital has come off the sidelines. And so all of the funds that are raising external capital are oversubscribed. They're getting tons and tons of money from people who are interested in this field and in this space. And so because of that, you've got a ton of money looking for a few deals. And so what that does, and what the challenge is for me as the general counsel of a fund is, when there's a lot of money going after a few deals, that means those deals are hard to get done. And so our leverage position in most of our deals is significantly weaker than it was 4 or 5 years ago. And it just pushes on all the hard parts of deals, because I know that if I won't take this point or that point or the other point, there's someone else who has capital they have to put to work who will take it.
Yeah, I just want to switch gears a little bit because in addition to the roles we've discussed, you're also a member of CapitalG's Equity, Inclusion, and Diversity Committee. So could you tell us about the work you have done with the committee and some of the issues that the committee is focusing on?
So this has been a really enjoyable and really challenging and really frustrating and really enjoyable thing to do. In the sense that venture capital is an industry that has historically been extraordinarily non-diverse. And we are making efforts both at CapitalG and industry-wide at changing that, but there are systemic and structural barriers to doing that, and walking through what is actually needed versus what is systemic versus what is structural has been a real challenge. That's why I say at times it's been frustrating. It has been rewarding because I think we've made progress, but it is hard. Let me give you a couple of examples. So when I started doing this job about 5 or 6 years ago, you could go to almost every venture firm and certainly every growth equity firm, and almost everyone who was working there at a mid-level or senior role had gone to Harvard Business School, had gone to Stanford Business School, and or had worked at Morgan Stanley or Goldman Sachs in technology. Like that was the entirety of the industry. And when you look at that background and you go look at the people who were at those schools, that background doesn't look like America. That background doesn't even look like people who doesn't even look the technology field writ large. And so you're trying to figure out on a hiring basis, on a recruiting basis, on a retention basis, how much of these sort of what I would call signals are necessary to the actual job. Like, do you really have that much of a better odds of getting a deal because you knew the guy from Stanford versus you went to somewhere else? And how much of it is just people hire who they know? And we as a firm and the industry as a whole have been really working through that the last couple of years. And we have made incremental, but not permanent, long-term sustainable change.
Yeah, and with the increased attention being given to racial inequity after the tragic events of last summer, we are excited to hear about Google's commitment as well to invest $100 million in Black-led startups, investment funds, and organizations. So could you tell us a bit more about that initiative and your involvement in it?
Yeah, so that arose out of the George Floyd situation. And I think, as you guys may remember, last summer, all across corporate America, companies were looking at themselves and saying, what can we do in our field, in our space, to improve racial equity in America? And asking ourselves that question here at CapitalG and the broader Alphabet family, what we said is, we know a couple of things really well. We know technology innovation and technology investment really well, and we know capital allocation really well. So how can we marry those two skills into some sort of a program that will move the needle, even if only slightly, for racial equity? And so what we decided to do was to focus on two things, to focus on investments in companies with which we had some sort of a relationship. So companies that either had spun out of Alphabet or companies that had former Alphabet people involved. And so we've made a couple of investments there. And we said, we really know investment firms. So let's go and seed investment firms so that they're sort of Black-led, because those firms are just statistically and in the real world way more likely to invest in Black founders, to invest in Black founders, and also then those founders are more likely to have Black employees. And so that's the work that we've been doing. We're not done, but it has been a really interesting journey, a really interesting process. And I will tell you that I'm very proud of what we've done, and I'm very happy I've got a chance to be involved in it.
Yeah, and it is very exciting to hear that Google, as a leader in the tech industry, has taken the initiative to make these commitments, and we are excited to see what other positive initiatives are like Google and other industry leaders are willing to take going forward. But also going forward, what more do you think leaders in the venture capital and growth equity space can do? And more specifically, I guess, what type of things can leaders do to address the inequalities within hiring and retention of leadership? But beyond that, what can leaders do to leverage their positions and make sure that capital is being deployed in a more inclusive way?
So there's a lot of parts to your question. Let me start with the capital deployment piece, because I think this is frankly the hardest nut to crack. Excuse me, and I'll tell you why, particularly in tech. So if you go look at almost all of the people who are founders of unicorns this cycle, for the most part, most of them worked at a unicorn the previous cycle. And so when you're looking to make systemic change in who is running and attracting capital in the technology business, you sort of have to look 5 years out, because the person who was running product at Twitter 10 years ago is now running their own multi-billion-dollar startup. And if all the people who were running product at Twitter and at Twilio and all these other companies 10 years ago all weren't diverse, you're going to have real trouble finding diverse people in 10 years to actually run the new businesses. So the first thing I would say is that it's all sort of interrelated. I think the second thing I would say is that there is a weird geographic concentration issue that has really negatively affected particularly entrepreneurs of color. I'm from California. I'm from the Bay Area. I grew up here. I went to college and law school back east. I live back east, but I know this place. And this is the hub of venture capital in America, as you guys know. This is not a sort of ethnically diverse place, in the sense that there are very few. We're not represented in terms of African Americans. We're not represented in terms of Hispanic people in the Bay Area, because it's so expensive. And so one of the things that people have been doing is they've been going to other jurisdictions like Atlanta, places on the East Coast, places in the South, because there are entrepreneurs there who look more like America than the ones who live within an hour of San Francisco. So that's sort of the other issue. And I think the third issue, which is also a struggle, is, most venture capitalists are 50-year-old white guys, just to put that out there. And the people invest based on their lived experiences, and the types of markets and the types of problems which they are targeting are different problems than what a 24-year-old kid from the Bronx is going to build a business to solve. And so there's a disconnect between the people who are making the capital decisions and sort of what I would call the 21st century businesses that are evolving, that there has to be some way to fix that. Part of that is diversifying the investment group, so diversifying sort of CapitalG and the rest of the industry. And then part of that is just frankly the people who are in leadership positions having an open mind and recognition that their lived experience is not everyone else's. And I missed some of the parts of your question, so if you want to repeat the beginning, I can take another stab at that.
Absolutely. I want to first say that was very valuable insight, because I myself have lived in the Bay Area for a year. And if there's anything I've noticed that was absolutely not representative of the lifestyle of an average American, in the sense that there is ever an average American lifestyle. So it is very interesting to hear like your approach and CapitalG's approach to find like leaders and like businesses that are more representative geographically and like in other aspects of life as well. And the other part of my question—
Can I just say one thing briefly, just quickly? The one thing I didn't say when I talked about like this job and all this stuff is, if you want a job like this, get some good luggage, because you're gonna spend a lot of time on planes. Because I would say we probably invest more outside the Bay Area than we do in the Bay Area.
Got it. Yeah, that is very exciting to hear. So my other part of my question is more about the hiring and retention of leadership in the venture capital and technology space. And I was wondering if you have any insights to share about that.
So I would say that I don't know if retention of diverse people is a big issue, because we haven't had enough diverse people get into the system, because hiring is such an issue, for me to have a really good, like, intuitive sense on the retention issue. The hiring issue is challenging for the reasons I articulated previously around like what people think of venture capitalists looks like versus what I think a venture capitalist should actually look like. And so, but I will say this, there are tools people can use. So one of the things that we have started using at CapitalG, and I know other firms have started using, is we do modeling tests that are blind, in the sense that people don't know who gave what answers. We do, some of our interviewing is done blind. We have actually diminished the weight and the value of referrals in our initial screening, because referrals means that I hire all the buddies of the people who work here, and I don't let folks who are outside the club get in. Somewhat, not always, but that's one of the sort of effects of using a lot of referrals. So we've done all of those things, and it has moved the needle a little bit. I don't have a panacea, and I'm not aware of any panaceas to totally fix the hiring process, but we're trying sort of every cycle to move the needle as much as we can. On the retention front, I think the things that we have focused on, and I know I can't tell you that if it's working or not, because we just don't have enough people in the system, is really increasing folks' comfort level, or at least making efforts to increase people's comfort level. And we're trying not to do, and I'll use a total stereotype to explain the point. We're trying not to do and not have this culture of sort of bro-y kids that went to Stanford, and trying not to do events and have a culture that is centered in that way, because that makes certain people feel less comfortable. And we know that when people feel less comfortable, they're less likely to stick around. Now, it's easy to spit out the slogan I just spit out, but it's harder to actually implement that. And so I'm going to be transparent and say this is a challenge. It is a challenge to build a culture that's not like that. It is a challenge to maintain that. But I will say one of the things I do like about where I work is we are at least doing the work and making the effort to try to make that happen.
Yeah, for sure. And I think Google is at a very unique position because it has the size and also the relevant technology to experiment and make these positive changes. And now you did mention I really appreciate your honesty in pointing out some of the remaining challenges that you see in the workspace. So do you have any thoughts on like, what do you think are the biggest remaining challenges, and like, what are the next thing that you're hoping to take on?
That's a really good question. I actually think the biggest challenge is going to be sustainability. So we had this George Floyd period and this really weird, hopefully never to be done again period of COVID, where everybody was just sort of home and there's all this craziness going on, and people made a bunch of commitments. And I think it will be challenging and require real institutional leadership and grit to, in September or December or whatever it is, we all quote unquote go back to normal, to stick with our knitting and to stick with, we think this is important. We're going to keep doing these things. We're going to keep pushing on this. We're going to make things a little bit uncomfortable around here and really try to change this industry. I wonder if every organization is going to maintain that level of commitment.
Yes, for sure. And I definitely hope that as we go back to normal, we go back to our daily course of life with a strengthened commitment to diversity and inclusion. And so we will honor all of these commitments that we made during the course of quarantine. And I want to thank you so much for all that insight. My last question before we open the floor to audience questions is that I know a lot of our participants today are HLS students with an interest either in growth equity or with an interest in just facilitating commitment, facilitating their commitment in diversity and inclusion. So do you have any final words of advice for our participants about how they can promote diversity and inclusion within their own organizations?
I mean, I think it starts with, like, organizations are collections of people. And one of the things that I always endeavor to do is when I am involved in a decision or involved in a personnel thing is to stop and make sure that I'm doing this in the way that I would do it for everyone. But also to recognize the humanity of the employee on the other side, the employee who's involved with this, because it is easy to say, well, we have a policy that says X, we have a policy that says Y, but a lot of times that, like, it's not fair to this circumstance or that circumstance, and it is worth it's worth stopping to think about it. Even though it's painful, even though you got to take more time, even though you don't feel like dealing with it, you should do it.
Yes, for sure. And thank you so much, Jeremiah, for all of your answers. Now, I'll be handing it over to Forrest for some audience questions.
Thank you so much, Jeremiah. Now, transitioning to the audience Q&A portion of this panel, we've received a lot of great questions. And the first one is, what is the specific role of the GC within a growth equity fund with regard to making investment decisions? And the subpart of the question is it within the purview of the GC to generate investment ideas, or is your role more focused on implementation?
Let me do the second one first, because the second one is pretty easy. We are an investment firm, like every investment firm in the history of the world, that is desperate for good and new ideas. If you work at a growth equity fund and you've got a great idea of how we can make money, there is no one at your firm that doesn't want to hear about it. The reality is, having said that, we have 20 folks that fly around the world all day and spend all of their time looking for investment ideas. And I spend all of my time on like legal and other stuff. And so the odds that I've got a great one that they don't know about, not high. But when I have raised my hand and said, hey, go check this thing out, people have ran over there and done that. In terms of what the role is, I think that really varies firm to firm. Some firms like CapitalG, I'm in every investment committee meeting. I'm in every sort of decision-making meeting we have about whether to make an investment and how and what to do with that investment. Other firms are a little bit more, hey, you go do the paperwork over here. It really depends on the personality of your firm and what skills you bring to the dance.
Got it. That's very helpful and very informative, especially I'm sure for a lot of our students and audience who are thinking about following in those footsteps. And the next question is, taking a step back, we're really seeing the advent of, it seems like, an increased regulatory scrutiny in the technology sector, from examples like the California Consumer Privacy Act to the SEC scrutiny over fintech companies such as Robinhood. And so the question is, have policy changes or even anticipation of policy changes impacted CapitalG's work with its portfolio companies? And have they impacted CapitalG's investment screening process?
So we had the misfortune, ultimately it turned out to be good fortune, we were investors in a company called FanDuel, which I'm sure you guys of course are law students and know nothing about betting on sports. I'm sure you guys have never heard of it. So we invested in FanDuel and we got doubly screwed on regulatory because New York State had this AG named Schneiderman who was out to get them and who had all these press conferences and threatened to sue everyone because they were trying to work in New York. They finally get through that, but there's really tough environments like 16, 17. They try to go merge with DraftKings, and we had the bad situation of being the first and one of the only deals that the Trump DOJ blocked, which no one could understand, because if there's one thing Trump likes is gambling. We could never figure it out, but they blocked the M&A deal. So to answer your question, yes, we've had a ton of regulatory issues, right? We're in Airbnb, we're in Lyft, we're in Robinhood, we're in FanDuel. I can go down a list of companies where we're at, where the regulatory environment has had significant changes to their business model, and it's caused significant changes to their long-term prospects. And so that's just the reality, just to answer the broader question, the reality of investing in tech in 2021 and further is that if you're investing in something that touches consumers in a direct way, so not enterprise businesses, but consumer businesses, once that business gets large, it will have increased regulation and scrutiny. Like that is just a fact of life. That's not going to change. And so when you invest and when you think about these businesses, you really need to have that in mind. Like I've got a guy at Google who helps us, who's a senior regulatory expert on the Google side. And whenever we look at any of these types of businesses, I just call him for an hour and get his gut feeling on it. And then I'll go call some outside experts because it's not going away.
Absolutely. And that is a really, really interesting point. And I think, Jeremiah, actually the next question segues very well into this, which is sort of in the face of regulatory headwinds and in the face of oversubscribed rounds and some would say too much capital chasing too few deals is, I think, how you put it. CapitalG seems to have had an exceptional track record over the past decade. What would you say are the elements, and I think you briefly touched on this earlier, of CapitalG's strategy, team, and or mandate that helps set it apart from its competitors in the growth equity landscape?
Well, I think the first thing I would say is that this is a people business. And so first and foremost, all these oversubscribed rounds, all of these challenges, we have sort of investment professionals that have high level relationships, credibility with high level entrepreneurs. That is until you have to start from there with any investment firm. If you don't have that, you might as well just stop playing. Once you have that, you can get in the game and you can try to get into deals. You can build up your firm around that. And we've built our firm to provide all these other services. And we've got Google we can lean on, but that is a core challenge, which is even if you know what's good, if you can't get in what's good, you're never going to make any money. And so we don't get in every deal. I will tell you that I've written more term sheets in the last year. My team has written more term sheets for deals that we go oversubscribed. We couldn't get in. We could only get half what we wanted. This is a hard market, but it starts with the credibility of your team and your ability to access the best deals.
Absolutely. And I think we just actually got an audience follow-on question to that, which is really that given the heightened scrutiny over the affiliation with the parent company, Alphabet, has that affected the investment strategy or perhaps been an impediment? And then also, do you think that the regulatory scrutiny has in any way deterred some founders or affected their strategy?
So let me start with the first one. Look, obviously being associated with Google has been a significant positive for us over time and today. We are, having said that, in relatively choppy waters from a regulatory and a public perception standpoint. For Google, like they're getting sued by the DOJ. There is a heightened level of regulatory scrutiny around all of sort of quote unquote big tech. And so that has affected CapitalG in some ways, not frankly too much because we're sort of viewed independently, but there are, I guess, I suspect, I don't know this, but there are probably some types of businesses that are just not good fits for us given the circumstances. I think your other question was about, what was the question about the regulatory piece?
Yeah, so has that regulatory piece, that very regulatory piece, affected how founders are perhaps thinking about who to partner with and who to accept capital from, given that there's just an influx of capital?
So I don't think that it's filtered down to the founder level yet in that way. And the reason for that is that most founders are too small to have that issue. They either sort of have it at their business. So when we invested in Airbnb, they already had the thing, and it wasn't because Google was coming to the party, it was because they already had the regulatory scrutiny, or they don't have it. If they don't have it, they tend not to be that focused on it.
Absolutely, that makes a lot of sense. And I'm sure a lot of our audience is wondering, given Google's sort of extensive investment activities, how does CapitalG's focus in growth equity fit within the broader investment strategy? You mentioned you had your experience partly is in corporate development and also, for example, Google Ventures. Like, where does the growth equity piece kind of fit in?
This is going to sound crazy, but you have to work in some places as entrepreneurial and a little bit wacky as Google to fully understand this. They don't think of it like most people would, which is that they have a consolidated strategy about which markets to pursue and how to do that. They think of it as, we have a group that's doing a good job, and we're making them money. And so you guys should go do that. As opposed to thinking of it as it's somehow a limited scope, that if we have this group doing that and that group doing that and they overlap a little bit, it causes an issue. That's not how they think about it. They think CapitalG is pursuing a mandate that has been successful. GV is pursuing a mandate that has been successful. We've got other groups over here investing for this corporate development purpose or that purpose, and we'll judge those groups based on what they do. And holistically, they're not going to say, well, you guys should move to the left a little bit, or you guys should move to the right a little bit. That's just not how we've ever interacted with them.
Got it. That makes a lot of sense. Well, I guess, going off of that, it seems like there's this track record of success across industries and across technologies. And I'm thinking and looking at investments that your team has made, such as Convoy, Airbnb, as you mentioned, and Oscar Health. And one of the things that some of our audience is wondering is, looking into the coming decade, are there certain areas of focus, perhaps internationally, or perhaps certain technologies that are particularly of interest from an investing standpoint?
So I want to be a little transparent with you. Are right that we have on the whole been successful, but I don't want people to hear this and think that we haven't had some absolute dud investments. If any investor ever tells you they've been running a business for 7 years making investments, they don't have any zeros, they're lying to you. Like, we've had some, it hasn't all worked out. I think to your question around sort of geographic, technological, or industry sort of things over the next 10 years, I will tell you, I don't have a good feel for that yet. I will tell you that we're spending more time in healthcare. We just announced an investment in a company called Strive Health last month. We're spending more time in healthcare. We're spending more time in fintech, and we're spending more time in two other areas. One I'd call sort of the future of work. And so we have a partner who is involved in sort of robotics, process automation company, and no code, and sort of all of these ways to sort of automate what I would call back-end technology. And then the final thing we've been spending sort of an increased time in is trying to figure out how sort of the global middle class will change things. And we haven't made any real bets there, but you can see this theme across a couple of things we've looked at and not quite got to.
That makes a lot of sense, and I think helps to really clarify and solidify what's actually happening and how these long-term decisions are made. And I think taking a step back from the investment work itself, Jeremiah, one of the things you mentioned earlier in the conversation is that your career has been a series of serendipitous developments and doing fantastic, great work. And I think a lot of students, myself included, aspire to that. And so I'm wondering, what kind of recommendations do you have for students today who are, sort of looking to follow in those footsteps? Are there things that one can deliberately do to increase the chances of success?
Yeah, so the first thing you can do is this, and every other business, but this business in particular, is an intensely relationship business. And so at every job I've had since I've been a lawyer, and this is true today, it'll be true in 20 years, I have developed long-term and lasting relationships with people in that environment. So the person who was my senior associate when I was a first year at Cravath, and I was like working like crazy hours, is now, I think he's like head of the corporate group at Cravath. And we talk like twice a year. And my mentor at Wilson Sonsini is still a friend of mine. And even in this COVID time, he comes over here like every 6 months and we have wine together. And my mentor at Google, who's now retired and actually bought a winery, and I had a Zoom last month. And so at every level of my jobs, I have developed long-term lasting mentorships and relationships. That is really important. The second thing I would say, and this is particularly true when you're a junior associate, is one, when you talk to clients like they're actually human beings and not stupid. And here's the thing that I think that sort of junior associates fall victim to all the time. Don't get so caught up in the paperwork and the documentation, particularly corporate associates, that you lose all sense of common sense. I remember, and I've seen people do this at every firm, like lots of firms. I remember we had this rush, oh my God, we got to close today, what's going to happen? And this associate actually called me and said, hey, we can send the money and figure the documents out later. And I paused, and I get it, she's been up all night, whatever. I paused and I asked her a question, and she had no answers. I said, if you were buying a car, would you pay for it first and find the car second? And like people get so caught up in, oh my God, the writer from section, like, first of all, stop and think, is this something that a reasonable person would do with their own money? Because that's what I'm here for. And the third thing I would say is actually, I'll use an old Bill Parcells quote, which is, you got to know how to fix something. He had this quote because like his team's losing, and he's like, look, I can't fix the offense, I can't fix the special teams, but I can at least fix the defense. And what I mean by that in this context is, you need to be an expert in something. So when I started at Cravath, I did a bunch of securities work, and I did M&A. Then I came out to California, I did M&A for 5 years. And so I'm not today, because I haven't done it for a decade, but I was an expert on public M&A. Like I used to draft, like I drafted so many public M&A agreements, and like it was all I used to do. And so I was an expert at that. And so that skill set is what I started with from a level of expertise. And so people knew that if they called me for that, I could do that. And then I built skills around that. But you got to be an expert at something.
Absolutely. And I think that's extremely practical, valuable advice in building mentorships, keeping the big picture in mind, and being an expert at something and building out. And Jeremiah, we've received so many great questions. And I think the last one that we have on our docket is beyond hiring, and this goes back to the diversity focus, beyond hiring and retaining diverse leaders and leveraging their strengths for equity, are there things that firms can do in order to address existing inequities? And also there's a follow-up question or there's a subpart as there often is in law. And the sub-question is, how are firms empowered to address these inequities?
So here's the challenge, and I don't have a solution to it, but here's the real challenge. The reason that I have been so focused on hiring, particularly for junior and mid-level folks, is that the risk of organ failure for senior folks, either culturally or just because the structure of things, is really high. And so it's really challenging to say, you know what, we're going to diversify from the top, as opposed to say we're going to diversify from the middle and the bottom. Like, I know it would be sort of probably quicker and easier to do it from the top, but institutionally that's very hard. Not because there's something wrong with the diverse candidates who are senior, but because organizations tend to have a much higher fail rate at the top than at the bottom. Because it's a bigger job and more responsibilities. It's easier to screw up as a CEO than it is to screw up as a junior employee. So that's kind of the first thing. I think there are things that organizations can do outside of just their own purview. So one of the things that we've done at CapitalG is we become a founding member of Black VC, because that's an organization that's trying to drive and curate and support the number of African-American VCs. We're working with All Race, which is the same sort of type thing. They're a little further along for female VCs. And so what we have tried to do is we said, okay, we're going to do what we can in our sandbox, but we're also going to fund and support activities to fix the broader problem. Because if there are 5,000 female VCs instead of 1,000 female VCs, CapitalG hiring 25 is all we really need to get way above parity. We got 40 employees. CapitalG hiring 25 female VCs is easier in a 5,000 person pool than a 1,000 person pool. And similarly, if we want to hire, this group or that group, if there are more people in the industry that look like that, it'll make everyone's hiring process easier to build a more reflective and inclusive workforce.
Absolutely. And I think that is a great note to close on, and certainly why our organization is so excited about the future. And so thank you so much, Jeremiah. And I'm going to turn it over to Cindy to close out the event.
Great. These are great questions and answers. I want to thank you both and thank our amazing audience for submitting these questions. Now, on behalf of the Harvard Association for Law and Business and on behalf of our audience, I want to again extend a huge thank you to Jeremiah for closing our symposium with this very important conversation. We are thankful to the speakers and the audience members for joining the talks this week, and we hope these important conversations continue to happen as we all recover from the impact of COVID-19 and work to address the impacts of racial inequality in our personal and professional spaces. We hope you all stay safe and healthy and wish you a great rest of the week. Thank you.